morning, Chris. How you doing?
Good morning, my friend. I'm very good. How are you?
I'm excellent. This is Brian Jones. I'm here with Chris Hood, professional trader, world's most interesting man.
Man, every time you say that, I just look at my picture on the camera and I'm like, man, you got to get out more, Brian. You got to meet people. You really do.
No, I mean you got some stories. You got some things to share. So I don't know.
Man,
You're
I've
up there.
got I've got a bad
You need a
haircut.
Dos Equis though. You need to be drinking all the time. Just fill it with water. Just fill it with water, so it looks like you're living that lifestyle.
Oh man, I'm gonna have to change my background to do something that looks a little better than a door. I'm moving house, so everything's moving to the next house, which strangely is right next door. When the movers ask me like, where are we going? I'm like, no, I just need your laborers to come and move the furniture. I don't need the truck.
Right.
So
I
it's
don't
going
know.
to
I think there's a certain realism to this. Like, people do all, like you were saying, there's all this jets and planes and beaches and all this other stuff. And then
yeah.
people, they need a dose of reality.
Yeah, people will never see me hanging around on a tarmac. I'm not going to be doing that. I fly coach and I drive a cheap car. I don't live the bling lifestyle. I don't think that this is an activity that needs to be FOMO'd. Like this is the problem with trading, is that everyone sees it as a hack or an easy solution, but it's actually really hard work.
Right.
And yeah, I don't like the way in which modern social media has made this out to be a simple exercise, because it's not. Like it just isn't. And many times when people have a simplicity or a simple based expectation that says, oh, I'm just going to go in and if I do that, then I'll get what that guy's got. But they don't don't realize there's this emotional piece that we need to deal with as well when it comes to trading with money.
Well,
And
reality smacks those people in the face.
oh yeah,
I mean,
look
like
at
the
Bitcoin.
4 million accounts that got blown up, all this stuff. It's like jujitsu. It's like you can watch all the UFCs you want and think, oh, this is, and then you go in and then you realize that you just tapped out from someone's cross-eyed.
Well, let's talk about Bitcoin for a second. So let's do it. Let's see. So let me open up a different chart. So hold on one second. I've got so many different chart forms here. It's just crazy. Okay, here we go. So Bitcoin. Oh man, you know that the Chinese government is putting in so many curbs and restrictions. They're cutting down the mining production on Bitcoin. So this is, I think we were talking about it about 6 months ago when we said, Bitcoin would come back down to around 28. That was our view back in January. And, that was when, up in January, we were up at around 60, right? We were somewhere over here and we were talking about how Bitcoin would come down to around here. So I remember the feedback that we got was, oh, why are people saying that? And you just look at it and it goes, these types of assets, I don't really call this an asset. To me, if I can't feel it, I don't really grasp it.
Right.
The governments of the world are not going to allow you to just disintermediate them out of the money game. Remember, the money game is what keeps them all in power. So anything that threatens the existence of the current social order, and Bitcoin does that, it takes the power from one side and moves it to the other. It's not going to be allowed for long. So I don't know. I think at some point you're going to find a revelation around the stuff that's going to fundamentally shift the swing towards crypto, and it's going to change the market completely. Whether it makes it good or bad, I don't know. I'm not a bull on this at all. I've never have been. I just don't grasp it at all. I can't trade it. So I suppose the fact that I can't trade it here in Canada the way that I could trade it if I was living in the US, it would be a totally different scenario. But this is a chart that's got so much damage. There's something to be said about people who say buy the dip. It's also like catch a falling knife.
I've seen the memes that say I bought the dip and it just kept dipping. Like,
buying the dip, it's actually quite easy to understand if a dip is a real dip or is it a sell-off, right? So the thing that you got to have, so all the viewers out there can make a note of this. You have to look at the relationship between the moving averages. All right, a dip is where the price drops, but the moving averages are still positively stacked. So your 8 moving average is above the 13, above the 21, above the 54, above the 89. All of those things are still positively stacked, and the price has just dropped below. A sell-off is when the moving averages have actually dropped and they're now negative. So the 8 is below the 55, the 21 is below the 55. So as soon as you get the negative stacking of the moving averages and price is now falling, that's the sell-off, right? So usually what you would look for if you've gone long in an asset, when the shorter duration moving average crosses over the longer duration moving average, it's your first indication of a sell signal. So you've got to see how that relationship is maintained. That doesn't mean the first day that those moving averages cross over, you bail out of the trade. It's usually the second candle. I usually wait for the next candle because that will tell me whether the first move is confirmed or not. Because if it just crossed over and then bounced back and I've exited, I would have missed that opportunity.
Right.
So position sizing solves 90% of your stress. If you oversize a position and suddenly these moving averages cross, you're going to run in, overtrade, make a sort of impetuous decision, and then you're going to pay the price. So everything between sell-offs and dips, I don't buy something because it's cheap. Just because I paid $100 for it last week and now it's at 60 doesn't mean it's better. And this is the problem a lot of novice traders will have, is that they will misinterpret value by price only. When you actually have to look at the relationship, you have to look at where volume is being bought. It's a far more complex relationship. So buying the dip, the only dip that I like to buy is the one at the supermarket that I can use on football days.
Yeah.
That's when I buy the dip.
What's your favorite dip?
Man, I've gotten into the cheese, the spinach and Asiago thing that they do up here, the artichoke and the hot one that they do with the chips. I'm pretty keen on that one. Not good for my jiu-jitsu at all, though.
No. There's a lot of calories in that, but I like it.
If I'm looking to go up from where I currently now am at super heavyweight, I'm looking to fight in the gargantuan division.
Yeah, you need to get on that sumo diet, the fish soup, and you can add in your own Canadian version with the dip, the artichoke, spinach, artichoke, Asiago dip.
That the dip, the concept of dip, back where I'm from, dip meant to hit someone. So, you would dip you would dip a guy would mean to punch him in the face kind of thing.
Oh, okay.
So, someone saying to me like, will you buy the dip? I'm like, I don't want to get punched in the face.
So that's South African slang right there.
Yeah, a little bit. We used to have a biscuit, like a rusk. I don't know if you know the concept of a rusk, but it's like a dried biscuit, and you dunk it in your coffee and all of that. But the advertising for it many years ago was dip. You would dip an Omar, which is a grandmother. You would dip the grandmother, and you would see these guys taking the rusk and dipping it into the coffee or tea, because the brand of the rusk was called Omar. But it sounds like you want to punch your grandmother, right? So to all the grandmothers out there, no punching.
They should have just gone with it. You dip, you take a bite and just punch an old lady.
Punch him in the face. Yeah. It's Afrikaans is such a wonderful language, but it's not spoken by enough people. You can't really say this is a global language. You're not going to be internationally experienced by speaking a language spoken by 10 people somewhere in South Africa. It's not. I love the language and the culture. It's a very interesting one.
So I had a question about diversification options portfolio. I was talking to someone and I was watching a couple of different videos about, there's the idea of diversification in a investment portfolio to kind of keep your volatility down.
Yeah.
Makes sense to me. But what about, in your options trading portfolio? What do you think about diversification versus focus?
The thing with diversification is it's like, it depends what you want, right? I find with diversification, if I'm trading an ETF, I get diversification within the ETF because of the structure of the ETF, right? So, I don't mind trading an index. I don't think it's worthwhile. I've put these 10 ETFs on the screen, right? So these are all sectors. Just diversifying and buying all 10 doesn't really do much, because all I would do is just buy the S&P 500 and I pretty much get what's covered here. And within each one of these ETFs, there's hundreds and hundreds and hundreds of stocks. So you're not really, I think from an investment perspective, diversification, 2008 changed everything for people, right? Because they thought, oh, I'm pretty diversified. And then everything got smacked. And the concept of, well, that shouldn't have worked. That shouldn't have done that after that. I don't really know. I think it depends on what you're looking for. Diversification can actually happen more at an asset allocation model, right? So you would look at it and go, well, I like the 50% equity, 50% bonds kind of approach. I'm not going to go and buy individual stocks. I can go buy one stock called, it's issued by iShares, and I get that diversification immediately based on that asset allocation, right? So I just buy one, done. That's my sort of reinvestment vehicle. I go 50% bonds, 50% equity. Any trade profits I make on the one side, I move into that. That's how I do it. When it comes to trading and diversifying across trading, there's something to be said about diversification, but there's also a strong argument that says, you know what? Focus. Because on the focus side, and you've seen how we do this, we pick the strongest, most liquid, best paying opportunities, high probability opportunities, and you focus your attention on those, and you allocate just a little bit more than you would onto normal, I call them the grinding trades. Those are the ones that are going to pay the bills, right? Mm-hmm. So let's say that you've got grinding trades at 1% allocation. On your focus trades, you could have a 3% allocation. The issue comes down is, well, what happens if you've got all your trades at one point, all in one sector? Doesn't really matter, because if that sector is the outperforming sector of the market, I would want to be there. I wouldn't want to be buying in the worst industry, in the worst sector of the market, just because I don't want to add more to the other, right? It doesn't make sense.
So you focus on what's going up at the time, or what's...
Absolutely. I think, relative outperformance at a sectoral level allows you to focus into a specific region of the market, and then you can look within those sectors for the best performers, because not everyone's going to be performing. And that's the way I do it, is I look at the graphs of the industries, the different sectors. You've got technology, energy, materials, real estate, utility, whatever. You look at these and you go, okay, well, where is the most green? If I'm looking for the most green, I've got it up here at technology in the top left, and I've got it down here in healthcare in the middle. So I would be looking at healthcare and technology as my first two sectors. Then you break down technology. You go, well, which sector of technology is the one that's going to be moving? And there's some simple tools. You can go into stock charts. We're going to talk about this in a second, because this graph that I've got on here will create a lot of interesting ideas. So here you go to the sectors, right? So we know that technology and healthcare are our two sectors that have got relative outperformance on the day basis, right? They were the graphs that had the most green. So you would look at the technology sector and you break down, you go, well, which sectors within technology are moving? Well, from here, over the 1 month period, we know software, semiconductors, and computer hardware are our top three. Okay, well, let's look at software as our first one. And you pull this up and you go, okay, well, my trading plan is I only trade large cap stocks. So I go down and I look for where small becomes mid and there's large at the bottom. So here we go. These are the large ones. So what I'd be looking to is, Adobe, Unity, ServiceNow, Fortinet. Those would be the 4 stocks that I would be looking at in that specific software component of the technology sector. Now we can focus. So rather than, I've got one trade in the technology sector, now I need a trade in, consumer staples, that makes no sense to me from a trading perspective. Investing perspective, I think you can overcomplicate things without, I still believe, just buy an ETF, just buy the index. You're not going to go wrong. And that's why I buy the 50-50, the 50% bonds, 50% equity. My job as a trader, I'm not an investor. I don't have the time to look at the fundamentals of anything. So I'd rather just pick the asset allocation that works for me and just give me the market.
Right.
So two different stories. What works for you is what's going to work for you. I think you should always trade to the plan that lets you sleep at night. So if you want to know what works, did you sleep well last night? Yes, then that's the plan. It doesn't matter what anyone else says.
Right. Don't cause yourself any undue stress.
Absolutely. I think the problem in investing, and particularly when you go onto YouTube and things like that, everyone has an opinion. Everyone, even me. I think what you've got to look for is what works for you, because the opinion of someone else that's doing things differently, they may be doing, their trade style, their emotional makeup might be completely different to you. And you know what? You could have 5 different strategies, 5 different people, all of them are making money. So who's right? At the end of the day, the only thing that counts is, are you making money? So you could use method A, method B. There's no hard and fast one strategy beats everyone else kind of mindset. I think if you do that in trading, you're going to constantly put yourself in a position of looking for something better rather than making what work. That's where it comes. So you might have something that works, that's diamond, that's, it's really, really good. But because you're constantly trying to see if there's something better, you're not refining the approach enough to make it the best for you. And that's the hardest part for most people.
I've noticed that, in most things, in most skill sets, trading being a skill set, it's you want to essentially imitate in order to get an example. So you teach your system, you imitate that system, and then you modify the system based on your body type, like in jiu-jitsu. You learn the fundamentals, and then maybe you're a guard guy, maybe you're a top game guy, all this other stuff.
There's certain truths that will flow through everything, right? So, the truth about allocation, right? It doesn't matter who you are. The mathematics are consistent regardless of what strategy you have. So you've got to understand the math. Then you've got to understand the tools. The hammer works the same whether you're trading X or Y. Doesn't matter. You've got to still know how to use a hammer. Same for the screwdriver and all of that. So learning how to trade the tool, fantastic. How the tool works in your plan, that's up to you. I teach my students and my clients a method that works for me. And I make sure that they understand what works for me might not necessarily work for you in the exact same way, because you might have a life where you've got 12 kids running around. You don't have 16 hours a day that you can sit in front of a screen. So you have to adapt a little bit in order to get the best out of the tool. And the tool might be a bull put spread or a credit call spread or a long call or whatever, butterfly, whatever it is. You have to adapt that tool so that it fits the work style that you've got. And most people don't talk about that. What they talk about is tools. Look at my hammer. It's fantastic. My hammer is better than his hammer. And no one tells you that if you hammer with this guy's hammer, you have to be doing it on one hand in a handstand against the wall. And it takes you 10 years to work that out. But his hammer still worked because it hit the nail, right?
Right.
But he says you've got to be sitting down with your hand under your butt, and you've got to be trying to swing the hammer from under your butt. It works for him because he's been practicing it for 10 years. That's the problem, right? It's like, I'm going to show you how to use a hammer. Now, in your circumstance, you might really not need the hammer. You might actually need a screwdriver. So you can't use the hammer for the screwdriver's job. And this is where I think a lot of not blind searching on YouTube or, just unguided education can be far more dangerous than anything else. If you don't have someone sitting next to you going, no, you need the hammer to face this way, otherwise it's not going to work. You could still be holding a hammer, but now you're hitting it flat. You're not hitting it with the right edge.
You're describing me trying to build something right now. This is my skill level for construction is very low. So I can carry big heavy things and that's it.
Dude, I remember leaving a country because my light bulbs blew in the kitchen. We physically moved house. I'm not a DIY guy at all, so I feel very out of place using a DIY analogy for this. But it's, the thing with trading, and particularly people who get involved in trading, is their interest is always far greater at the beginning, right? They're excited, they're enthusiastic. It's like white belts coming into a jiu-jitsu school. They just want to learn everything. And what I believe is there's certain that you've got to learn the certain truths, right? These are the truths that are going to be absolutely paramount throughout your trading career. Allocation, boom, number one. You don't learn that in the first month, you're screwed, because you're going to end up getting seduced by the theoretical outcome of the tool. So the tool becomes really attractive. It's like, man, I love these things. I'm going to trade these. I'm going to load up that butterfly with 9% of my account. Probability, like 5%. You're dead. You just lost 9% of your account. To come back from that is hard. So you've got to be really careful. So there's certain truths that I want to teach first. And I always say to clients, there's certain tools that are absolutely critical at the beginning, right? So certain trade strategies fit certain types of people at the beginning perfectly. If you can't make your account work with the simple, high probability, low profitability trades like bull put spreads, if you can't make a consistent income from that, you have absolutely no reason to be learning the low probability, high profitability trades like butterflies at this point. Like, that to me is like, what's the point? You'll blow out your account doing those butterflies because you're low probability before you even get a chance to make any money. So what I like to teach is develop consistency first. Develop a form of consistency that gives you the license to then speculate, because butterflies are very speculative, right? They're highly technical. At certain levels of application, they can be quite complex to do. So if you're not making some consistent income on the side, you have not earned the right to put your account in jeopardy by doing trades you don't understand. Like, that's just the law, right? 6 months maybe of doing put spreads and call spreads, then you get the application into the next layer of trades. So there's for me, I have certain degrees of complexity. And it's very, very difficult explaining to someone how to do a condor if they don't know how to do one leg of the condor by itself. The whole concept is very hard.
All the advanced strategies, a lot of those are essentially just multi-legged versions of the basic strategy.
Absolutely. All an option strategy is combinations of contracts. That's it. It's nothing more than that. But understanding the relationship between the different dimensions of that trade, when you've got a 1-2-1 or a 3-2-1 or a 5-5-5, like whatever you have, you've got to be clear on how it applies to your outcome. So you can't trade without a goal in mind. You can't trade without knowing how to manage it like a business. And that's what I try and teach my clients is, how do you manage your trading business so that you've got inventory of product, your tools, your hammer, your screwdriver, and all that, that are delivering the result that you want to achieve at the end of each month, right? And what takes people away from that outcome is usually themselves. It's usually bad habits that were never learned at the beginning, like position sizing. The amount of times I've seen people blow themselves up because they can't position size properly is just ridiculous. They don't know where to reinvest. If you're not reinvesting your profits in something other than, I don't reinvest my trading gains in more trades. I don't do that. I take my trading gains and I put it into my ETF, which is the 50-50, and I let that grow with the market. And I have a specific allocation of my total portfolio capital that I use for options. So unless you're doing that, you don't grow your account. Because if you don't know your win rates, you might be losing more of your profits without managing your tools. It's really complex. So without learning that, it becomes really difficult. I think focus trades are really useful. It minimizes your amount of time in front of the screen. It forces you to be far more consistent with the application of your studies and how you want to trade. So yeah, there's reasons to do, I can't go long and short at the same time. It's hard. I find it difficult, but then I'm just old and maybe not that smart. So I don't know. If someone younger with more mental dexterity can go long and short at the same time, that's great for them. Hasn't worked for me. I like to be either long or short. And if I'm long and the market goes short, then I try just, bring my positions down, go to cash and wait. And then you wait for the setup that works for you and you take advantage of that.
So you you had something to that you were wanting to talk about today.
Yeah.
For
this week, right? So,
yeah.
Week after triple witching, June, summer months starts getting into, starts to become problematic for people, right? The liquidity starts to dry up. There's this rebalancing of the Russell. There's going to be new guys, going into the index. Some guys are coming out of the index. There's going to be a lot of price volatility. So one of the things that I try and stress with, particularly guys within the Alpha Hunters program, is I don't want to just be adding trades and creating volume for people that haven't been thought through, right? I really believe in the eat your own cooking kind of approach. Any trade that I give out to our subscribers, I do it myself. It's real money that goes into it. I don't just have a paper account. It's real money that goes into it. So I'm going to show you something. This is a site that I use called SeasonX. I use this to understand context. All right. And this sometimes is really important for traders. I don't follow seasonality blind. All right. Just because it happened before doesn't mean it's going to happen again. It just gives you context to things. All right. So when things go wrong and you look at the seasonality, you can add a layer of understanding that says, yep, the seasonality is playing out, right? So I would expect this to be more consistent, right? So that's the only reason I use it. This is the week where we are now, all right? This is the week where we are now, 21 June to 27 June. This is the S&P. I'm going to increase this to 28 years. For 28 years, look at that index. It's just down, right? Now, we may be at this point 1 week ahead of the cycle. We might be 1 week behind of the cycle. But according to history, this is a terrible week for every single index, all right? So here we have the S&P. Let's have a look at the Dow. Okay, similar basis for the Dow. I'm going to look at 23. There we go. Same week, negative, right? There, 27th is Friday, or 25th is Friday. There. So that's the Dow. Let's look at NASDAQ. Same thing, right? All three indices over 20 plus years have really been straight down.
Yeah, that's not a good, doesn't seem like a good time to go long. And
no, so last week on Friday, when we were doing the trades for the following week, I made it very clear to subscribers that, look, next week doesn't look good at all. If you are going to trade, you have to be trading at prices that make sense to you. Don't just be adding, all right? What you want to do is wait for these pullbacks, right? You want these trades to be falling so that put premiums go up and you can sell those put premiums at good value. Because what I want you to do now is look forward 1 week. Look at the history of the next week. All right, so now we're looking towards first week and second week of July. Let's just look at the week there. For 22 years, look at that rising pattern. That's for the Qs. That's for NASDAQ. Let's look at the Dow. So similar pattern, right? So it's all a question of, can you survive this really bad decline in order to position yourself for the rise? So we've also been talking about what's going to happen over the remainder of the year. So if you start looking at the remainder of the year, we know that September, we've been saying for some time, the month of September to sort of October is going to be calamitous. I think it's going to be disaster for a lot of people. And I think a lot of people are going to get suckered in because of these small rallies that tend to happen. When you see these sort of vertical lines going up here, people get, suckered in. They go long, 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 and then they get wiped out. It's this that kills more traders. It's this sort of hope rally followed by the massive decline that kills most of the people because they overload here and then they lose. But what you've got to do is you've got to be looking at the market going, how can I capitalize on these micro trends that sit in here? By the time we reach middle of July, we'll pretty much have made the highs for the year, I think. All right. That's why we were starting to look at bearish positions last week. We started to position ourselves a little bit, because what we want to be doing now is capturing this. And in short trading, when you go short in the market, you can make your money far quicker. You make your money far quicker trading this way than you do going this way. But imagine if you can make some good dollars this side and then position yourself for this increase that happens over that period here for the Christmas rally. That's what we want to be positioning for. So keep things light, keep things easy. On pullbacks, know which stocks you want to do and what tools you want to use on those stocks. So remember the 3 ATR moves, remember the moving averages. When the stocks come down to those moving averages, we know that the 50 and the 20 are holding support for the indices, right? So when the markets move down to those averages, we want to be looking at the major stocks in those indices and buying those. We want to be going long in the Googles, the Amazons, the Facebooks. We want to be doing trades there. So it's almost like this counterintuitive psychology that you have to have. You've got to be able to survive that in order to get that. So when the market starts falling, you want to be going long. You want to be buying things in this time, not selling your positions and trying to chase the dip, right? Or chase the end. You know, when you've got these positions that have now started to lose money, kill them quickly, get out of them. Once you start finding the base, well, so we know what technicals we need to look for to establish a base, we start going long. And that's it. Just stick with the indices. But this kind of data can contextualize and help plan a trading cycle. So we were like, you know, on Friday, just do nothing. In fact, we've pretty much gone to 80% cash, because what we're looking at is our focus trades. So our focus trades are Nvidia, Apple, Google, Amazon, Facebook, Roku, Microsoft, triple Qs, technology, healthcare, Dow, and these are just leverage versions of the indices. That's what we're watching. As soon as we start seeing these starting to fall, and you know where the net change is, you know, red, that's when we're going to go in and start buying, start selling put spreads, start adding some of our long positioning for the rally that we expect to see in July. And then once we get to sort of mid-July, it's about making sure that by this stage in mid-July, we've got our bearish positions aiming for the end of the year or for the end of September. So long-dated bear put spreads, et cetera, on weak stocks. Doesn't mean they're not going to be rallies, right? There's still going to be these periods where you have the market moving up, but what we want to capture is that longer trend facing.
You like trade the macro trend and the little micro rallies as well.
Yeah, you can play 1 week trades here, 1 to 10 day trades, but you know the longer duration trade is definitely going to be towards the downside. So very, very interesting site. This very interesting context for trading, just to keep your head about yourself and to help you plan. You know, for this week, I've planned to go very, very light. You know, I'm not looking to add an inordinate amount of trades. We've reduced our portfolio by almost 60% in terms of number of positions. So, you know, we don't have a lot of stuff on the book at the moment, but we are very, very heavy in cash. So
yeah, I took profits early on quite a few things yesterday and on Friday last week, and I've not really added a whole lot of trades. So I'm just
I think we exited Nvidia, Apple, Google, Amazon. We killed those trades, not because they're not going to work. It's just I'd rather wait for a pullback to go back into them. You know, we already were at a profitable position. Let's bank the money. We've banked the profits. Let's now look at the next 2-3 weeks and see where we're going to be. If Google pulls back to the 21, I'm going to be in there. You know, I've got some alerts waiting for that to happen. I don't really want to be watching anything else. You know, these are the trades that are going to pay well. And now it's just a question of patience. It's, you know, you got to sit on your hands a little bit and wait for them to materialize. But all good. I think that, most people get suckered into these rallies, right? They sort of see these little one-day blips in the market going to the upside. They go, "Oh, everything's changed. Life is great." And then they throw all their money in, and then the next day, you get hammered. I mean, I'm just looking at my Almanac here. By the way, if anyone really wants a nice resource, a desktop resource, grab yourself a copy of the Stock Traders Almanac. It's available online. You can subscribe online. And what it's basically saying to us is that Tuesday, Thursday, and Friday of this week are seasonally some of the worst days of the year. Not just the month, but of the year. So, we might be a week behind. We might be a week ahead. You've just got to be patient and see how this plays out. But I'm certainly not overly enthusiastic. The problem that I see is, if I look at what's changed over the last 10, 15 years that I've been trading, it's more the access to information. The development of things like, the Fed talks far too much. I mean, every week it's another guy coming out and saying something. I wish they would just keep quiet just for a while, just zip the lip kind of thing.
Right.
Zip the lip and take a dip. We could punch him and see what happens.
Well, there was the whole series of tweets, I think with Trump tweeting things that kind of made the market do a little.
Yeah, and then you've got these celebrities. You've got I have a deep amount of respect for hedge fund managers. I think their jobs are hard. I certainly don't cry when they lose, because I know that they're fleecing us at every possible opportunity. So any opportunity I see with these Reddit guys to even the score, good for them, really glad about it. The problem is, though, the damage that social media has caused in terms of creating the perception about what trading is all about it's pretty damaging. And I think a lot of people are going to take some pain on it, because it's not, you can't survive or make a career out of meme stocks. That's the problem, right? It's just sad. I think that we don't hear enough stories about how many people have lost money. And I think if they did, it certainly would put a stop to things. But it's all good. I always trade as if the guy on the other side of the trade is a bit more experienced than me. So when I win, I feel vindicated in a way, because I know that 90% of the time the guy's probably just a beginner. But that's the way you got to trade. You have to trade as if your counterparty is the guy from a hedge fund, and he has more information than you. So when you trade and you go, well, that order was filled really quickly. Did the other guy know more than me? Is he getting a better deal?
Yeah,
it can happen.
No, I mean, that makes sense. But I mean, with all the new people in the market, the liquidity in the market from the new retail traders, I think it increases your chances of.
Yeah, I mean,
but a lot of them are focused on the meme stocks, it seems like.
Yeah, I think this whole social media thing where we idolize people, and we take their opinions too much. Like whenever someone comes out, this is the way I see it. Whenever someone comes out and says something about the market, you have to discount it with a lot, because a lot of times these people who are given a voice, who are given a stage and a platform, will talk their book. They're going to say what's in their own self-interest. When you have Michael Burry coming out saying that he's shorting bonds, well, clearly he wants to short bonds, right? So the more people who start shorting bonds, it gives him an opportunity to get out. When Elon Musk is talking about Bitcoin and all of that, he's talking his book, right? It's in his self-interest for those things to go up in price. So I think you've always got to be discounting a lot of the stuff that you see in the media. I don't pay any attention, zero. In fact, I know a lot of traders that put the TV on and have CNBC on mute and whatever. I spend no time listening to the garbage that gets spewed out of news outlets, because by the time they produce anything of fact, it's already happened in the market. Like, you can't act on that information. There's no way you
flows quickly.
Oh yeah, by the time you get it, this is a harsh reality to anyone. Okay, by the time you hear something, it's already happened. There is no, you have no edge in the information war when it comes to trading stocks. The only edge you have is the interpretation of data, and that data is only available through charts. There's no news edge. By the time one journalist writes something and puts it on your MSNBC feed, it's old. It's gone. You can't act on it. So you have to be pretty diligent not to be influenced by half that. I haven't turned on the news in years. Like, I just won't. I refuse to listen to, made up guys. They add zero value. The news is designed to make you anxious and give you fear so that you stay tuned for the next tidbit of information that they can then sell you another. The problem is most of the ads that they have going in on these shows are for people my age. Like, I'm so tired of seeing ageless male. Like, come on, cut it out. Cut it out. I don't want to see those ads anymore. Really, the best thing you can do for your trading is not join any WhatsApp groups or Reddit boards. Like, honestly, learn how to read a chart. And it's not a hard skill. It's just practice. And life will be easier.
Yeah, definitely good advice. Well, Chris, just got a couple minutes before the bell, so we'll sign off for the day, and I will talk to you next week.
Thank you, man. It's always good to see you. I can't wait to get back on the mats. I can feel it coming. My nails.
Yeah, for sure. Well, I will hopefully sooner than later.
Hopefully, my friend. You take care. Look after yourself over there.
Okay, you too. Take care.
See you guys.